This panel is Hedge Fund Hot Topics, and I just want to introduce our panel. Jisha Dymond, who is Chief of Staff and Compliance Counsel at OZ Management. John Pollard, Director of Compliance, EJF Capital. And Dan Kahl, Co-Deputy Director and Chief Counsel at OC. So he is our SEC representative. And I think we're going to start out with Dan giving us an update on initiatives in OC's private fund unit.
Thanks, Pat. First thing, I'll give the disclaimer: my views alone don't represent the commission, any of the commissioners, or my fellow staff members. And as Pat said, I was going to give a brief overview of the PFU, some of their initiatives, and also mention a few of the most common deficiencies we find in private funds, sort of a mini private fund risk alert. It'll be a lot easier doing this than, as if you've heard all the issues about getting anything out in print from the commission, it's not easy. Just a quick overview of the private fund unit within OC. So OC is roughly 1,000 staff strong, 750 or so are actual advisors. The private fund unit is our only really specialized unit. It's part of the IAIC program, and it's about 25 persons, 20 to 25, depending upon staffing nationwide. So it's not a big unit. It's has a depth of knowledge though in hedge and private equity, a lot of experience. The examiners are very attuned to the industry. That being said, those are not the only examiners that do private fund exams. Regional staff, all of the regions will also take on private fund exams, and there's often a discussion between the unit and the region on how and who are doing exams, and there's an exchange of information. Depending upon the type of exam, I think you're more likely to see the unit, more complicated exams, more complicated structures. I think largely you'll see the unit. Maybe you'll see regional staff go along with them as well. And also, we frequently have people going out with the private fund unit for training opportunities as well, from other parts like investment management lawyers, the Division of Investment Management. Sometimes, rarely, you'll see enforcement lawyers. They'll always identify themselves as where they're from and what their purpose is. And it's usually if somebody is tagging along, it is for training opportunities. Also, the private fund unit relies heavily on our QAU, or quantitative analytics unit, and those are the people who can sort of delve into trading in a sort of the mass data dumps, the neat tool that was talked about. And so you'll often see QAU members, which is a separate standalone unit, going out in the field as well, or dealing with all of the trading records that you're asked to produce. As PFU thinks about priorities, I think there's sort of three underlying principles they think about and what they're doing annually, and it's opaqueness of whatever you're doing, and sort of getting to disclosures or non-disclosures, frankly, of style, conflicts, whatever it may be, but the sort of the quality of disclosure or lack thereof, the complexity of the offering, complexity of your shops, that of course will drive risk ratings and factors as to why we would want to visit, and lastly, of course, conflicts of interest, types of investments, types of funds, types of investors, strategies, and all of that. So those are sort of the three high-level areas that the PFU thinks about as they develop what they're going to look at each year. This year, I think there's sort of 5 major areas the private fund unit is looking at, not all in hedge, but hedge and private equity as well. One of which I think we've been very public about, side-by-side management with registered funds particularly. Particularly if you see similar strategies, obviously, that's going to be of keen interest to us, and this marries well with the sort of beating of the drum of retail, when we see side-by-side a retail-oriented product, a registered fund, and a private fund. You're likely to see us, or more likely to see us this year than in past years. And what they're going to look at, it's I think pretty obvious areas, but I'll just mention them. Portfolio management, portfolio construction between the two products, obviously, brokerage practices, trade allocation, when you're aggregating and allocating orders, when you have the products side by side, allocation of fees and expenses. I don't, we've heard it over and over again, fees and expenses. We are going to kick the tires on that. And then the disclosures you're making, not only to the LPs, but to the fund boards and fund shareholders of the conflicts you're facing and of your practices. So that's sort of the side by side in a nutshell. And I say that's probably the biggest initiative for this year, the private fund unit. Other areas they're looking at private funds that have a concentration of high net worth investors versus institutional, and looking at investor qualifications, sort of suitability of product, who the investors are, and relationships with investors and things along those lines. A continual or sort of evergreen area we look at is MNPI and how you deal with it, particularly in the hedge fund space. Lack of controls around dealings with corporate insiders is a huge issue that we find repeatedly. Obviously, that's not only in the hedge fund space, but across all advisors. It just becomes a big area in the hedge fund space as you're looking for performance, and well, you know that. Situations of manager stress, and this is an area we've looked at in the past, but we're continuing to look at. Suspended or gated funds, it's going to be a big red flag, and we're going to try to go in and make sure you're not exploiting investors and you're treating them equally when you're facing stress situations. And lastly, fund restructurings. If you're winding down a fund, to make sure, again, investors are treated equally on the way out, or if you have other restructuring that's going on, it's going to raise our interest in what you're doing. Those are sort of the big areas the private fund unit is looking at. There are also just risk-based exams. Initiatives are not the only thing we do, and I know the private fund unit is spending a fair bit of time getting out to never-before-examined private fund advisors. There are still many of those, and if you're of significant size, in the billions, and you haven't seen us in 7 to 10 years, we view that as an elevated risk, and there's an initiative or thought, or an allocation of resources to get out to see you as well. Those are the priorities, essentially. I'd also take a few minutes just to mention a few of the most common deficiencies we find in private fund advisors. My staff, if you saw, I think I mentioned this on Monday, have cataloged all the deficiencies over the last several years in the IA space, and we can slice and dice it. So my staff did it for me before here to say, here's the most common private fund deficiencies. And they're not surprising, a lot of what's typical of other advisors, but I think they're worth mentioning so you can take back just to look in your own shop to see how you're doing in these areas. Surprising one, though, is compliance with the custody rule vis-a-vis the audit provision, delivery of audited financial statements within the allotted time period. We still find advisors who are using auditors that aren't PCAOB registered and subject to examination, surprisingly. Incorrect fee calculations, Mark Perlow suggested there may be foot faults. I think our perspective is when investors and clients are not getting the deal they signed up for, it's a little more than a foot fault, and oftentimes it's more than just the one-offs. And usually when we find foot faults, it's usually throughout many of the firm's operations. So those are big red flags. So fees and expenses, and they can get incredibly complicated, obviously, in the private equity space and a hedge waterfall of fees and things. Codes of ethics. This is tying back to the MNPI area. We see lots of weaknesses and controls over MNPI, as well as the sort of the rote requirements of codes of ethics, the personal securities transactions reporting. We know it is painful, but it is sort of low-hanging fruit when we see sort of senior staff or portfolio managers not reporting in compliance with the rule. And then lastly, sort of the catch-all that we are always on the look for, conflicts of interest and how you deal with them, disclosures you make, controls you have in place, and whether investors are adequately informed of the conflicts that you face. That's it in a nutshell.
Well, that was very informative. Thank you. We are going to take questions as we go along, and I would just urge anyone who has a question to just raise your hand. This is a small group, so we'll be able to do that. But that was a very good segue to the rest of our discussion. We are going to talk, and we've got 50 minutes. I don't know that we're going to be able to cover these topics comprehensively because you could have a separate session on any of them. But we're going to talk about some hot topic areas which I think all come under the umbrella of conflicts of interest, which is the case for a lot of issues that are, a lot of troublesome issues or difficult issues for legal and compliance in the hedge fund industry to deal with. So we're going to talk about side letters, allocation of fees and expenses, cross trades and principal trades, and valuation. And these are all areas of intense, I would say, SEC focus in the examination and enforcement areas over the past few years, and they can create significant challenges for legal and compliance departments. And we've got a great panel here of experts, compliance experts, and I think the way I'd like to approach this is we want to get an understanding of how firms can get their arms around these issues, how you can adopt effective and implement effective policies and procedures, how you actually can put in place the mechanism to monitor, and then the biggest challenge, I think, is disclosure and dealing with that as, you know, as time goes on, because it's very easy to craft disclosure and then it sits there and it's never revisited. So side letters, first topic. Obviously, a lot of people here are familiar with that, but it's special rights that are negotiated by most commonly institutional investors. And, you know, certainly what we see is that they can raise big conflict and fiduciary duty issues and significant operational and monitoring challenges. So I would open it to John and Jisha in terms of, you know, does your firm deal with side letters? I think, you know, our advice is always don't, but that's almost impossible. So
I'll start.
Yeah.
So we have, you know, dozens of side letters. 90% of our investors are institutional. The way we think about it is, you know, there's a lot of different institutional investors trying to protect different interests, and that's why you see a variation on side letters between corporate pension versus a fund-to-fund versus, you know, an ERISA account. And that's creating a variation that will never be commoditized because everyone's trying to protect their own interest in the best way that they see fit, which creates a lot of complexity. We took the view a long time ago that we will only negotiate on fees and reporting, which has made our lives a lot easier in some senses because, you know, if you think about the institutional investors that request this, during the onboarding process, they'll send a DDQ across. And one of their questions is, what are your side letters? What do you frequently give in on? And we can disclose right up from front and say, look, we only negotiate on fees and reporting. The rest, you've kind of come to the nuisance. We're not going to negotiate any other kind of provisions in there, which helps us kind of operate from an ivory tower. That being said, I used to be a member of the commission. I've seen a lot of kind of creative things come across that's of interest to the commission. You know, liquidity rights is obviously something that people care about. The ability to co-invest or invest in certain segments of a fund that is not otherwise available to other investors. Those are hot button issues. But, you know, I think from a standpoint, the reporting side alone creates a lot of operational problems for us and complexities. So there's an onboarding process, and once a side letter is done, we sit down with an all-hands meeting, and usually we break down our reports into, you know, 4 or 5 different segments. What is a GAV report? What is a NAV report? What is a notification? What is a transparency report? And we'll assign a key stakeholder who is responsible for that. As compliance, we're primarily responsible for the notification provisions. When a key man has left, when, unfortunately there's been a bad act, things of that nature. We're in charge of those types of events, but we also forensically test how the other units are doing as well, as we oversee that as well.
I'd like to come work there since you limit it. We do not limit it to fees and reporting. We have we're a little bit more flexible to the
Investor-friendly.
In terms of the provisions. And, that's the, I think, I agree with John in terms of making sure that everybody knows what everybody's supposed to be doing is sort of the biggest challenge, right? You have to negotiate and make sure that it's fair and disclosed. That's one thing. But in terms of the firm and sort of how to practically address the issue, it's understanding what are the terms and who's monitoring them. And that is a firm-wide sort of effort to understand that. And when we say what are the terms, it's not just passing on the very legalistic terminology to the accounting guy. It's making it in a way that's understood, right? And putting it into plain English so that they understood what the term really means and understanding who's monitoring. So at our firm, We have something called, that's internally built, a proprietary software called Investor 360, and it's really sort of the golden source of profiles of our investors, and includes the CRM program that we use. And part of that is the side letter sort of module, where once a side letter is negotiated, there's a lot of obviously process that goes into that negotiation itself. But once it's negotiated, the attorney or disclosure attorneys who negotiate them will put it into the system and kind of summarize the terms that are applicable. And then it initiates a workflow, and it goes directly to the departments, the accounting, operations, compliance, to say, here's a new side letter, these are the terms, and we identify which, similarly to John's firm, identify which department is monitoring which, who's monitoring the economic terms or the, of the side letter, primarily accounting, and, compliance is looking at other, notification and other kinds of terms. And so I think the biggest challenge with side letters is, yes, the substance itself and making sure that it's something that you can manage, but if you're say you're going to do this for them, then you have to do it. And that process of making sure that everybody is on board is really crucial to it. We also have a monthly meeting that's legal, compliance, and accounting. And the standing item is always side letters, even if we have something to talk about. If we don't have something to talk about, we confirm that we don't have anything to talk about here. Because, you can have as many systems as you want, but sometimes something slips through. So you just want to have that additional sort of ability to catch any kind of gaps.
So
No,
I just,
please, go ahead.
from the 1,000-foot level, the exam perspective, we're sort of agnostic as to whether you have 2 areas or 200,
Yeah.
or whatever it might be, whatever your side letters are. But when we come in, we're going to ask and make sure you know what the provisions of your side letters are. And while you may be concerned largely to make sure you're complying with your side letters vis-a-vis each client, our biggest concern is the impact of the side letters across clients and the conflicts they create and how you monitor for those and how you perhaps have to disclose for those, particularly material. And that's going to be our sort of first question is we're going to get the side letters and we're going to make sure you understand them. And again, not just understand individually, but collectively their impact. And then we'll ask about how you go back and test to make sure you are following the side letters and you are, if you identify the conflicts that you are tracking and keeping up disclosures, or as new side letters come in, as the marketing department finds a new area they want to give some other clause to, and then the whole MFN clause area. So that's sort of the 1,000-foot perspective, or sort of first slash at side letters when we come in.
Yeah, and I can tell you just from our experience representing a large number of private fund managers, we see this focused on in the exam setting continually. And I think one of the biggest challenges is disclosure. Now, you may not have that challenge because of the narrower band of areas where you're willing to give a side letter, but I'd be interested to hear from the panel what your views are on how you get a handle on the disclosure and then how you continually kind of refresh it, because this is not a static area. You take new investors in every month, and how do you get a hand? And, we know we've got the may versus does issue in terms of disclosure, which sounds simple to deal with, but it's not. So I'd just be curious.
It's pretty simple, just don't use may.
Right.
I just don't understand the
But
complexity.
sometimes it's actually true.
You may still not want to use it.
I don't know if you have any disclosure thoughts. If not, we can.
I mean, I think we refresh our PPMs every year, and if there's a material event that would, either side letter or other event otherwise, we try and capture it in the ADV, which we can do more timely. The PPM is a little more time comprehensive and time involved, but we try to make disclosures that are event changing for our funds done in almost real time.
Yeah.
Yeah, I think it's a similar approach. I don't think our refreshes every year, but it's about that. But I think the ADV is a good way to start. It's important, obviously, to get it all in there, but that usually is, that review is what's going to trigger saying, okay, are we doing what we said we would do? But yeah, the other side of disclosure is also, I guess, what you're disclosing, but also when your investor comes and says, I want to see the other side letters in your funds in this.
Right, and how do you deal with that?
We generally permit it. It's redacted, and it's only an in-office review. They come in for, when they're coming in for their due diligence check, they come in, and the binders are all ready to go. And it's a bit of an exercise, but, saying no just doesn't seem like an option.
Accepted. Yeah, likewise, we take the same practice. I mean, some of our funds have, a much more manageable number to disclose and redact, and some have dozens within them. And,
Yeah.
So they can spend a lot of time.
They're welcome to
Yeah.
it.
Yeah, and from the staff's perspective, unfortunately, we sort of have a put. We come in and we'll look at your disclosures
Oh, yeah,
and see the practice.
absolutely.
The transparency issue, if we see, well, I wonder how often, if investors are asking for transparency, you're not provided, whether they're still investors, but
Right.
that's kind of
Right.
a business decision.
Yeah.
But the whole point of it is the areas we're looking at is, again, they want transparency to make sure that they're aware of the conflicts that their investment is facing. Sort of the same thing we do on an exam. We would hope there's always effective disclosure. And when we view effective disclosures, essentially there's enough information so the investor understands the conflict and is in theoretic, consenting to it. And that's the purpose of disclosure. And that's why things like May doesn't often work in effective disclosure. It's not necessarily improper always, but often doesn't work as effective disclosure. If there's not enough information for an investor to understand the conflict and understand that they're going to be disadvantaged and to accept that for whatever reason, because maybe they like the performance or they like the manager, they style, whatever it is, but that's the whole point.
Sorry, yes.
This is a very quick question for Jisha. And you say you have quite many sellers. And if there's anybody require that they want the best sterilization treatment
What's
MFNs, yeah.
Of course, all the time. They do, but I mean, that's a very challenging sort of area, and something that we manage. But it's not. It actually hasn't come up like more recently, but
And this question is for John. And when you see negotiating on fees, I guess that's all kind of a volume based, so it's kind of fair to everyone. You have large volume.
Yeah, traditionally, it's either timing or size. If we're starting a fund, and we'll give founders a break, or sizing break points.
Okay, we're going to turn to allocation of fees and expenses. This has been, I think, as everyone knows, an SEC exam and enforcement priority for over 5 years. It kind of started with the private equity industry, but clearly, certainly from my experience, and I think the panelists will probably agree, the hedge fund industry has also been swept up. Certainly the way we look at it, the SEC has been very, I think, clear about what its expectations are. There have been a lot of administrative proceedings. There have been risk alerts, exam priorities, and so everybody should have a clear idea of kind of where they should be headed. It's a huge conflict area, particularly when manager expenses might be allocated to clients, or one group of clients is favored over another group of clients, whether it's intentional or inadvertent, without specific disclosure. And the other thing I would add is that issues, when they're detected, whether in the exam setting or otherwise, can lead to a scenario where the manager really has to reimburse clients. And so we wanted to generally talk about how you got your arms around this issue, because I think it's not that it came out of nowhere, but it kind of came on the scene in a big way, and I'm not sure that hedge fund managers were as attentive to the issue as they should have been.
Sunlight is the best disinfectant.
Yeah,
That's kind of-
Sunshine Beach, yeah, that's great.
Yeah, I mean, for us, obviously disclosure is a key to this area as well, and ensuring that you're as detailed as possible in the PPMs and as well as the ADV. But I think, again, there's sort of an operational component here. Who is doing the allocation between the appropriate funds and between the management company or the GP and the LPs? Who is doing that? Is it accounting? Is it operations? And do you have a handle on that? Are the questions being escalated to compliance? Because, I think some firms take the tack that, compliance reviews every allocation. I don't know if that makes sense, because a lot of times you have repeating expenses. There's no reason to do that. But I think this also comes down to systems and making sure that the way that the folks that are actually doing the allocation are appropriately trained, they understand the issues. For our firm, this was sort of highlighted, and, be frank about it. We discovered an issue, a significant issue, which required us to look at every single expense for a couple of funds since their inceptions. We had to reallocate expenses for all of those funds. We issued the refunds. We then issued disclosure to the investors. We put it into our CCO report. And lo and behold, 6 months later, the SEC came for an exam, said, let's see your CCO report. Here it is. It's right there. The question is, when you found the issue, did you do all the things you were supposed to do? And for this particular issue, if in doubt on whether to disclose or whether to issue the refund or whether to be as transparent as possible, the answer is yes, in my opinion. I just don't think this is an area where you want to be taking a lot of risk given the focus. But, we were, I mean, maybe not we, but I was definitely nervous about that. But we did the right thing. It was fine, and so I think, sometimes you have to pick your battles and things like that, but this is one area where I'm not going to guess.
I would just comment on sort of the real life perspective of remediation. From the exam perspective, we view remediation incredibly positive. Our principal tool for pointing out problems is deficiencies, but the numbers of advisors we get to is small, and the biggest value, I think, as I said yesterday, is the value of compliance taking a role and firms taking a role in sort of self-policing. And when we see that, that's incredibly encouraging, and that's sort of, if we come and find a problem and you haven't remediated, or there are issues and we identify and you don't remediate, and we can't force you, we're not going to force you to remediate, we don't have that authority or power, and that would be, overreach. But when we identify problems and firms voluntarily do it, it only inures to your benefit, because our principal way of sort of tackling firms that we find recalcitrant, for lack of a better term, is making an enforcement referral. And if you're troubled by an exam, you're going to be really troubled
Yes.
by the enforcement program. And fees and expenses is an area that, you have to stick your head in the sand if that you don't see that as one of the biggest priorities across all programs at the commission and with the commissioners themselves.
I think we have a question already.
Yeah.
Question on it in terms of remediation.
Mhm.
It's fairly easy if you discover an issue to reimburse the funds. It's a lot more difficult, particularly if there's
As investors have gone.
discover something that's been going on for a while, people have redeemed and that's actually a ton of work to go back to individual investors. So I guess the question is there some, when people talk about remediation, is it remediating the fund, assuming it's below a
Yeah.
certain dollar amount? At a certain level, I think we need to go out to outside investors, but.
That's a great question.
So there isn't a bright line test, and and this is the type of discussion based upon the facts and circumstances. It's hard to say, right? In any event, any remediation fund, obviously investors would be preferable, but the complexities, we understand that, and there's a materiality issue always, and those decisions and that sort of balance gets into whether we consider there still to be a serious problem. And my guess is that would be communicated to you if we don't find the remediation acceptable or fulsome enough is probably the better way of looking at it. So I would imagine there to be a discussion about that. We don't want you to take shortcuts, but I think there's realists too.
But there is a recognition of the.
Oh, absolutely, yeah.
I'd also offer another analog too, which is, your class action lawsuits, your antitrust lawsuits, sometimes the harm that's been done to your fund, to your clients, happened 3, 5, 10 years ago. and you don't get a check until 3, 5, 10 years later, and, we have disclosure about that, and that might be another place to beef up your disclosure about that type of instance as well. One in the back.
Yeah.
Do you make suggestions on best practices for refunding, say, fees and expenses? What do you think, just the amount plus interest? Do you take performance into consideration?
Yes.
I think we're going to let Dan answer that.
Yeah.
All of the above?
I think these are very fact-specific, right? And I think that, I think you should, depending upon the situation you find yourself in, is make sure sort of senior management is on board with whatever the remedial efforts you're taking, and have that story ready, and make the best case. I think, I believe our examiners are relatively reasonable. I think there's probably differences of opinion on that. A delivery of $20 and it's going to cost you $150 to do it. We get that, right? So, no, there aren't bright lines.
One question I have for our industry panelists is that there are a couple of really tough areas, I think, for when your clients are funds. And it has to do with, there's always a desire for your disclosure to be flexible because you have to live with it over a significant period of time. And how do you deal with new expenses that weren't contemplated at the time that the fund, you update your fund documents every year, that may be one answer, but what considerations do you take into account when you're evaluating whether you need to perhaps get investor consent to change your expense provisions or your expense allocation practices?
So for new vendors and new thoughts here, I think the greatest source of friction comes into the research and overhead expense,
Right.
those buckets. And if it's a new vendor, clearly there's usually an onboarding process where they're doing due diligence on them, which one do we want to use, and there's a lot of lead time to prep your PPMs if you do want to kind of engage that practice. And you give fulsome disclosure saying there's a new vendor, this could be material fees, it could not be, and you kind of waive redemption rights if it is a material event. For every new vendor that is less so than that, we create a memo. We have a memo that each business unit that wants to use the new vendor explains why, what the value add, why this is not overhead, why this is beneficial to the fund, and we have multiple business units kind of review it and sign off on it. But yeah, like those, I'd say the choke points are new vendors, changes in fees and old vendors, and T&E. I think at our firm we spend a lot of resources on fees and expenses, and try to remain efficient in other areas, code of ethics and otherwise. But I review every T&E that hits the fund. And just have discussions with analysts and PMs, and we use the PMs also as safeguards to kind of help control what hits their fund and what research expense can charge their fund as well, because they know best what is actionable and what is not actionable.
I rely on the crystal ball of my disclosure attorney. He has one, and he knows what's going to happen in 10 years. No. I think having broad language is obviously helpful, but there are things that, technology is a big one. I think, obviously, the kind of technology that has been used is different than, when some of this disclosure was drafted, than when it was drafted. Bloomberg used to be considered a hardware, now it's a software, and, mixed use, bring that in, it becomes sort of challenging. Other things are offshore sort of tax structures, right? And sort of, did you, maybe you didn't have those structures in place when, 5 or 7 years ago, and now you do, and how are you addressing those? And so, you hope the language is as broad as possible so that you can reasonably, of course, make sure that it's allowed by the documents. But, again, it comes down to refreshing and making sure that the PPM and the ADV, A, align, and that they're saying the same thing, and B, that, they're updated to reflect these new practices and your policy, because that's the other thing, is making sure that the policy is addressing and trying to be as specific as possible. But I think the challenge is these things that were categorized one way, but now they kind of serve a different purpose. It's challenging, but you hope for broader language on that.
this is where I might disagree on broader
Yeah,
language.
yeah,
I mean,
I know.
so-
There's a fine line, right?
So,
It's too broad,
when we're
right?
looking at fees and expenses, we'll, look over a period, and almost certainly we're going to ask for new fees, different allocations, for you to identify all of those changed fees, whatever it may be. And we're going to ask, what was the methodology? Was it consistent? Who was responsible? And it's sort of going to be rote. It's going to be part of our fees and expenses. And then following that, the question will be, well, where's the matching disclosure to your LPs?
Right.
And if it is too general,
Right.
that's if it has words like may. We're going to question whether that was effective disclosure, particularly in the conflicts and
Yeah.
material business practices. And that's where we may start having discussions about, well, consider remediation
Yeah.
because it wasn't
Well,
effectively
and
disclosed.
I
But
think
so it's a challenge, but it's going to be asked.
Yeah.
If you're going to be
No, and I
yeah.
think it's also, because, you're trying to get folks that want to use the new service to articulate why is this for the
Exactly.
exclusive benefit of the funds, right? And
Right.
there are some who thinks their being is for the benefit of the funds. Just by existing, I think about this, I'm refreshed now, I slept, and now I'm ready to go. No. But that sort of articulation and making sure that you're documenting, I think I agree, is a key sort of point.
I'd just like to throw one thought out, because certainly we heard Dahlia Blas talk about disclosure this morning and effective disclosure, and I think she was speaking more about the RIC world, but at a certain point, disclosure can become so voluminous that perhaps it loses its effectiveness in terms of, informing investors. And certainly when you look at trends in this industry, if you look at ADV brochures, certainly of, large private equity managers, all of a sudden you've got 4 pages of very detailed listings of expenses, not even types of expenses. And I guess I just throw out the question, when have we gone too far such that it's difficult to kind of run the process in the business?
When your PPM hits 400 pages, I don't know. Yeah, especially when you have to look back at those documents to make, to constantly update them. You have complex businesses, and therefore you have to have complex disclosure. But like you said, at some point, is it serving the purpose? Are we apprising the investor of the risk? Yeah, it's a challenge, and I have no solution for that.
Yeah, I have no answer, but.
I just editorialize, and this is not these are my views, but I think you actually are in a better position than many advisors because of your clientele being sophisticated, and hiring lawyers to do diligence, and so there's a whole industry around reading your disclosure. So when the disclosure is on page 200, I think from many of the staff's perspective, and it's not universal, obviously, the quality of the disclosure is more important than where it might be, because we think your documents are probably analyzed a whole lot more than a mutual fund prospectus or an ADV to a retail investor when you put on page 30 in the footnotes, the most important disclosure. And I think it's not a get out of jail free that because, institutions can protect themselves. I think we found that that's really not the case by all the enforcement cases. There's a view that institutions can't necessarily see. But when it comes to understanding disclosure, I think you actually have the benefit of dealing with a more sophisticated clientele.
Yeah.
I think we put a lot of disclosures in our ADV as well, and I think one thing that we kind of helped us when we had our SEC exam 2 years ago was we instituted a process where we deliver our ADV electronically on the website and in paper form, but we also took a look back and who actually logged on to view their ADV, and we re-emailed those people that didn't open their ADV just to ensure that, look, there is delivery here. I think that went a long way with the staff. I'm not going to speak for all the staff or Dan.
Well, back to my I did 15 years of advisors policy, and I was part of the team that did the new brochure. And one of the big issues was at that point was at 2000, early 2000s, the private fund industry suggesting and the commission affirming there is no delivery obligation because they're not your clients.
That's right.
So we're not going to question that process, but we're going to question whether because they don't have to read it, they don't have to receive it. But the point the business practices, of course, I think you're going to provide it because we're going to have, if you're going to rely on it for a conflict, it's irrelevant what the rule says.
Right.
That's just the reality.
Yeah.
Next topic, cross trades and principal transactions. I don't know if this is a big topic for this panel. Certainly in the fund industry, rebalancing transactions are cross transactions. They can become principal transactions. It is, I think, sometimes a trap for the unwary, and we've seen a significant focus on this in the exam setting. The initial request will ask for information about cross transactions, and to the extent you haven't then identified principal transactions and the staff identifies them, then it's a whole nother discussion, but I'd be interested to hear from the panel.
I think one of the biggest challenges with these is making sure you're identifying them, right? And
Right.
so who's your first line of defense on that? It's your PMs. It's the folks that are doing the actual transaction or considering the transaction. So how do you make sure that they have the knowledge and the ability to identify these things? And that's training. That's compliance training, I think. We have an annual conflicts of interest training, and it's sort of identifying these conflicts that are specific to our firm, right? We have a credit desk, we have an equities desk, we have a real estate desk. What are the kinds of conflicts that you can come across as a result of that? And so making sure that the PMs are very well versed on this topic and can identify it when they're contemplating it is, I think, key. And then having them being able to escalate it to compliance and taking it to the conflicts committee if necessary, or otherwise documenting why, the price is fair amongst the funds is key. But to me, this is one of those things where if the PM doesn't know enough about this topic, that's where you're gonna be caught flat-footed for your.
I would agree too on the identification side. I think the definition of cross trades is growing a little bit. If you think about investments through SPVs and there's some erosion through the actual value, I think that can be viewed as a cross trade. I think I'm hearing from my colleagues that participation notes for tax purposes are being viewed as cross trades in some way, shape, or form. So you got to be mindful about it's not just a simple trade blotter analysis of a buy and sell between two clients at the same time, or your firm's name on the other side. Identification is huge, and sometimes you have to worry about a supposed straw man. If it's a follow-on offering, and funds go from one through an issuer to another, you have to be very mindful of that as well. Identification is huge in just seeing what the universe is of conflicts that come out there. We as a firm, we create a memo, we have an LPAC committee, we put it before the board. Valuation is always number one out there, and it's always a very, very thorough and robust debate, but they can serve a purpose. You've seen cross trades can help funds that are seeking liquidity in illiquid markets and help funds that are seeking to upscale or upsize on that opportunity.
How do you monitor? How does compliance get comfortable monitoring? Because if you have like a creeping 25% situation, it's too late after the transaction is settled. And so that's a challenge that we've seen our clients kind of deal with.
So for us, that monthly meeting that I actually mentioned between legal, accounting, compliance, this is also a topic where we address the percentage thresholds and just to confirm that we're there. I don't think I'm comfortable with a 3 to 4 week lag, just waiting until the next. Of course,
Right.
if there's something happens and there's some kind of redemption or something happens, I think we're confident with our fund accounting team to escalate the issue. But I think you have to have proactive monitoring on this, whether it's a meeting, that's not very high tech, or whether it's a high technology solution where you can, view things live, sort of how the information is being processed. But I think you have to be very proactive about that. So.
I think they both make excellent points. I don't know, from the exam perspective, what Jisha's describing are the types of things we're going to be asking and looking for, particularly in a shop the size of yours. The one note, the LPAC, great tool. One of the concerns or one of the questions we're going to have when you're using LPACs to get consent is what you're not going to them for consent and how that decision is made. What's the decision point, LPAC or not? And what's sort of the next thing that you didn't go to the LPAC for and why, and who made that decision and the thought process.
The only other thing I would add to Jisha's point from an operational standpoint, we also include our RISA numbers as well in those meetings. You know,
Right.
It's
Yeah.
another kind of
Yep.
easy kind of threshold and talking point to kind of get through if you don't want to be a qualified plan asset or you're trying to avoid that.
Yeah,
Yeah.
yeah. Next and final, question?
Yes, someone mentioned how valuation, the second gentleman, valuation is important. Not sure if this is a panel discussion or if this is maybe a question after the session, but we have some funds that have unique assets like life insurance policies, funded funds. One holds vehicle equity that holds life insurance policies. How would you, are there valuation policies and procedures that we can look to for guidance on that and also compliance testing?
So I don't know if you've read the Hamlin case, but do the inverse of that. That's our first point. You know, I won't say always, but we try to aspire to transact cross trades, and we've only done a handful, at the last month's mark, and whatever was held at there. And then we try to effectuate the cross trade days after that valuation mark happens, because you don't want a stale price that this is being transacted at, and you have to kind of negotiate and operationalize with your prime brokers, the clients, you know, just trying to schedule an agenda with all the committees. That's the only kind of advice I can offer.
I can give you a little perspective. Obviously, the SEC isn't going to come in and tell you how to value your positions. That's your job. But what we are going to look for is consistency in process. And if there's changes in process, why that happened. And particularly if you're out fundraising and their valuation changes, huge red flag. Or if it's a stress market condition and we see significant changes in valuations, memos and understanding as to how that and why that took place. And we frankly expect you to test valuation, so look backwards. So whatever process you've established, try to confirm whether it's actually effective by back testing. And frankly, you know, you read the cases. If there's important information to investors about valuations, you know, if you're buying, the principals are buying out in closed funds positions from investors, make sure valuation is you're not hiding anything. That's just basic information to investors.
I think you're looking at my outline
Oh,
here.
sorry.
Sorry.
Third party or consultants that
Well, and I think, you know, if you listen to Mark Dowdell in the previous panel, at least in Philadelphia, they look at independence as a obviously a diminishing risk factor. And I think obviously we'd agree that if there's fulsomeness and adequate independence in a third party, of course, yeah. As almost any process you have.
Yeah, and that was something I wanted to touch on with valuation, because I do think that's a challenge. I always, you know, when advising clients, I think the difficulty is you need the required expertise in order to evaluate whether the firm is valuing, you know, in accordance with your policies and procedures and in a reasonable way. And if you have hard to value assets, it's unlikely that legal and compliance have that expertise. So how do you get comfortable is, you know, how do you have enough independence in the process but have the involvement of the front office so that you're comfortable that, you know, you're doing your job?
You know, we have a valuation group within accounting, right? That is what they are focused on. They're certainly getting the information that they need from the investment professional to inform their decision, but ultimately it's in their hand. We do have a valuation committee comprised of the senior executives as well as senior folks in accounting to ensure that, and they meet every month to review it, and we have an outside firm that is valuing the same thing next to our accounting group to make sure that it matches, and if there's an issue, if there's a discrepancy, then we're going to have to figure that out. I think there has to be, you know, it's always interesting to me when firms value to like the nth dollar, and I'm like, is that really possible? How do you do that? But I guess that's why I'm not in accounting. But that's what it comes down to is like, you know, are you having enough comparison and, you know, to make sure that this one sort of conclusion, are you testing it and making sure there's several ways to do that?
The only thing I'd add, sorry, go ahead, your question.
I was just going to ask, from time to time you hear whispers that the SEC might be rethinking issuing valuation guidance. That doesn't seem to have been the hottest topic over the last day or two here, but just curious curious if that's still on the.
So, yeah, I've heard those whispers, so I'm sort of the same position as you. Being an OC, we don't make policy, that would have been a question for Dahlia Blass. And I'm not aware of anything that's imminent, but it is completely possible you'll see it tomorrow. I mean, I just,
Only other thing I would add to Jisha as well is, I'd say the large or vast majority of our assets are level 2 assets, so we're getting broker quotes on those, in which case we CC our auditors, our administrators as well on those quotes, so they can get real-time transparency. They're also part of our evaluation committee, and it's a robust debate. Anytime there is anything that deviates from the norm in the kind of valuation process and calculation, that's probably the only other aspect I'd add.
Well, I think amazingly, we covered our topics. I guess if there are any any additional questions, we'd be happy to take them. Otherwise, I think we just want to thank our expert panelists. No? Okay. Thank you very much.